presenter today is Dr. Sonja from CFI. We're going to talk about how financial institutions and Fintechs are partnering for financial inclusion. Let's look at the front line. But just very briefly before Dr. Kelly starts, we just go over the agenda. I'll just take you through the DFSO. Then we're going to do a quick poll, one question. Then there's a live 15-minute Q&A after the presentation, so please send me questions. I'm Leon Perlman. And then there's an optional live quiz afterwards, 10-question multiple choice, just after the Q&A ends. So look out for the quiz link in your email, and please check your spam folder, because sometimes the emails go to spam, especially in Gmail and Hotmail. Just to let you know that the quiz is only live for 2 hours. If you're going to do it for certificate purposes, you can earn a certificate after 2 hours. The quiz results will not count for certificate purposes. And to do the multiple choice quiz, you really need to take attention of the slide content themselves. So a bit about the Observatory. We've been around since 2016, funded by the Bill and Melinda Gates Foundation. Go to our website. There's a big legal database. We're also doing model laws and regulations. We have an annual summit, a lot of webinars. We do roundtables. We have a roundtable on de-risking coming up quite soon in New York. A number of publications we're working on, commentaries and analysis of new laws and regulations, and we collaborate with industry regulators, academics, donors, and standard-setting bodies around the world. These are sets of webinars. The next one will be on faster payments. Then we've got ones coming up on interoperability, on mobile money fraud, and go look at the events page on dfsobservatory.com, and you'll find the series of webinars that you can register for. So again, as I said, you can earn a certificate of attendance. You need to attend 6 webinars and get 60% each for post-webinar live quiz. So again, if you do the quiz after the 2 hours, it won't count for certificate purposes. So again, please concentrate on the slide content on today's webinar. It will be sent just as the webinar ends on the hour. Okay, so we're going to start our webinar just about Dr. Kelly. Sonya is a good friend of the Observatory. She's Director of Research at Center for Financial Inclusion in Washington. She conducts and facilitates financial inclusion research at CFI, directing the CFI Fellows Program, developing frameworks to understand critical concepts like financial health and financial capability, and facilitating the global microscope research. She has a doctorate in international relations from American University, where a dissertation focused on financial inclusion policy and regulation. She's previously worked at the World Bank, CGAP, and Opportunity International, and you can follow Sonya through that handle. And I can say we're in capable hands because Sonya is one of the world's top financial inclusion experts. So over to you, Sonya.
Thanks so much, Leon, and a big thanks to the DFS Observatory. You all do such great work to equip the financial services industry for the shift we're seeing to digital, and you make enormous contributions to financial inclusion, including many ways you've contributed to the Center for Financial Inclusion. So thank you so much for inviting me to share with your audience today. I'm Sonja Kelly, the Director of Research at the Center for Financial Inclusion, as Leon said. CFI is an action-oriented think tank. It challenges and engages the industry to protect and empower consumers. Our interest in this topic on partnerships between fintechs and mainstream financial institutions is not just because fintech is very cool, well, it is very cool, but because we're interested in the ways that fintech empowers and advances financial inclusion. So that's really the angle that we bring to this topic. Even though this is a well-discussed topic in the space, we're really looking at the financial inclusion angle here. Thanks as well to my co-authors on this study, Ferenzi, Elise McGrath from CFI, and Dennis from the Institute of International Finance, our partners on this work, and then as well to the MetLife Foundation, which generously funded the research. My style is to hopefully steer clear of boring, but if you are, if during the presentation you find that I'm not being completely clear, or if you have questions, please feel free to put those questions in the chat box, and if we don't get to them during the presentation, we'll be sure to get to them at the end. I should mention that the report that I'll be discussing, you can find it at bit.ly/partnering Fintechs, and you can see that on your screen in front of you right now. So without further ado, let's go ahead and get to the report. So this research is, like I said, a joint project of the Institute of International Finance and the Center for Financial Inclusion. It's the first of 6 different deep dives exploring best practices for financial inclusion, and this one is specifically on partnerships in emerging markets. Our methodology was simple here. We looked for a lot of different partnerships all over the world between fintechs and mainstream financial institutions. We found what we thought were the most successful ones. We reached out to the mainstream financial institution that was part of the partnership, or in some cases the fintech where we couldn't get a hold of the financial institution. And then we tried to figure out what makes them tick. Like, what are the common challenges that these partnerships face? What are the strengths that they build on? We highlighted 14 of these partnerships in depth. We have an extensive case study on 14 of them throughout the report. These are partnerships that are all over the world, but are primarily operating in emerging markets in terms of the products that they offer to consumers. And then we also included in our interview sample experts. So we had 10 experts for a total of interviewing about 30 people. You might think of this report as a compendium of partnerships. I'm going to be giving some of the data and the insights that came out of this research, but you could read more about this in the report. Again, the link is bit.ly/partnering Fintechs.
Sonya, could you move your slides? It doesn't seem to be moving.
Leon, it looks like she dropped off the call.
Oops, okay. Sorry, folks, we're having some technical difficulties today.
Hello, everyone. If you've joined us late, we were having a couple of technical difficulties, so please stand by. We've got a slide up, but we're reconnecting the audio for you. So thank you again for your patience.
Sorry about that, everybody. Hopefully you can hear me again. Okay. I'm going to ask the organizers to send me a dial-in number in case that happens again. All right, so it's like the funniest thing to me when the DFS Observatory has on their webinars technical glitches, because it just underscores for me some of the infrastructure challenges that we have, even though we're speeding towards this digital revolution. Anyway, okay, so I was talking about these partnerships and giving an important caveat, and that is that looking at successful partnerships means that we missed the failures. And one of our interviewees, one of our expert interviews, told us that he estimates that about 80% of prospective partnerships end up in failure. So that's a pretty significant percentage. And having said that caveat, you should think of this research as aspirational and not representative. So I have the fortunate job of telling success stories here. I love this because this research actually turned into something that was really interesting, and it's mostly good news. Usually I have to share some bad news for it to be interesting, so that was pretty cool. Now this research is counter to the narrative that we saw just a few years ago. There was an article in The Economist a couple years ago that many of you may remember. It was entitled "Slings and Arrows." It said, Fintechs are little more than pinpricks for a banking mastodon with trillions in assets. And it painted Fintechs as this annoying opposition to mainstream finance. And this research underscored for us, and obviously we know that you know, the industry has moved in a different direction, but this research underscored that instead we saw Fintechs and financial institutions as pursuing symbiosis, and that to me is really good news. So here on this slide, you can see the full map of the partnerships that we looked at. And you will notice that they cross borders, they cross time zones, and they cross language barriers. In other words, instead of going to their next door neighbors, financial institutions are canvassing the globe to find their partners. Now, we would like to call Fintechs and mainstream financial institutions a potent cocktail. They both have strengths, but together they're much, much stronger. And we'll talk a little bit more about some of the ingredients of this success. But you can see in this slide some of the strengths that financial institutions bring and some of the strengths that Fintechs bring. Financial institutions, first and foremost, have a big brand, they have name recognition, they have relationships with customers, existing relationships. I like to tell the story of my own financial life, in which when I was 8 years old, my parents took me to a bank that was just down the street from our house, and I opened up a bank account. And I still have that, that bank account today. Of course, the account was given to other banks through mergers and acquisitions, but I haven't changed my banking, and I think that's pretty significant, even as I've added in other services like Venmo or PayPal or you know, other forms of payment. So I'm maintaining that that brand that I stuck with. Fintechs, on the other side, have a culture of innovation. They're nimble, they have agility and get to the market more quickly. And so together, this is, as I said, a potent cocktail of disruption. If you were at the summit that the DFS Observatory organized in June, you heard Chris Skinner say that mainstream financial players are looking through their rearview mirrors while Fintechs zoom forward. And you know, I think Chris Skinner meant that to be a criticism of mainstream finance, and I think that criticism is warranted. But I think that that's not the full picture. You know, I think that in my personal opinion, and this is something we can talk about when we get to the discussion portion of today, but in my personal opinion, I think you need to have a rear view mirror to be safe, but you also need to be looking forward, and together Fintechs and financial institutions can do that. Institutions are not willing to partner on just everything. We heard from Ujjivan, which is a financial institution in India, that they don't want to get into software development. They see it not as part of their core business, so they look for a partner who can develop a solution for them. But there are things that are part of their core business that they do want to keep internally. And we heard Carlos Lopez Moctezuma of BBVA describe this by saying, the things that are core capabilities for the bank, you want to develop or acquire, whereas the things that complement your offerings but are not core, you can gain through a partnership. So again, we we see mainstream financial institutions as holding on to these core things while they're also going out on other things for partnerships. And I'll talk a little bit more about why I think this is important in a minute. We see partnerships as uniquely suited to addressing barriers to financial inclusion. And financial institutions learn a great deal about financial inclusion, about new customer segments or poorly reached customer segments along the way. There are four things that I think are primary challenges that financial institutions seek to overcome through partnerships. So I'll share an example of what each of these four looks like. First of all, gaining access to new market segments. So one partnership we saw was Diamond Trust Bank. Now, Diamond Trust Bank is partnering with Kopo Kopo in Kenya and also in Uganda to serve retail merchants. Kopo Kopo, as many of you probably know, is a fintech startup that equips retail merchants in East Africa to accept digital payments and offer small loans. And DTB, Diamond Trust Bank, and Kopo Kopo teamed up to create a product called Pay Easy, a mobile wallet connected to a DTB account for merchant use in Uganda. In Kenya, the two institutions partnered up with a third institution, MasterCard, to build QR payment capabilities for the merchants. So this partnership aids Diamond Trust Bank's focus on reaching SMEs, which are Kopo Kopo's primary customer base. Without the partnership, Diamond Trust Bank doesn't know that it would be able to reach this customer segment, and so that's pretty cool. We saw BBVA, which is BBVA Bancomer in Mexico, partnering with Chilean-based fintech Deepening. Through this partnership, they provide credit to consumers who've been denied credit through BBVA. And I don't know if you can see this slide closely. I know it's a little bit blurry, but Deepening provides an alternative credit scoring platform on which it builds a credit score that's based on the customer's bill payment history. BBVA Bancomer partnered with Deepening in the hopes of expanding credit to thin file customers, especially those making $100 or less per month. With traditional risk assessment models, BBVA Bancomer was only approving about 10% of customers in this segment that the partnership addresses, and they saw a great opportunity to expand. And so you can see in this customer journey that the customer puts in a loan application for BBVA Bancomer and then is denied due to poor traditional credit history. And then the customer is directed to the Deepening website. So BBVA is not connecting them directly, but they're saying you can go to this website and you can put in some information and then we can see if we can approve you. Deepening then receives the customer profile and puts together an alternative credit score. The customer then receives the credit score and can submit this to BBVA Bancomer for a review. And then once BBVA receives the new score, it can approve the loan dependent on the risk appetite. The customer receives the loan. What I think is really interesting about this is that the customer actually owns all of their data at every step along the way. So the customer is the one giving the data to Deepening. The customer is also the one receiving the credit score, the alternative credit score from Deepening, and then the customer is the one that delivers it to BBVA. So in addition to being an alternative credit scoring company, it's also a company that promotes the customer ownership of their own data. In the second use case of partnerships for financial inclusion, we saw partnerships creating new offerings for existing customers. And I'll show you an example of what this looks like. There's a mainstream financial institution in India called ICICI. And ICICI partnered with Silicon Valley-based blockchain company Stellar to create a mobile wallet for its customers. So customers in India and living abroad can transfer money through this free mobile wallet. And you can see in this image what happens from the customer perspective, what happens from the Stellar network perspective, and then what happens from the ICICI bank perspective. So basically, a customer on their mobile phone opens up their mobile wallet, and they transfer some money from their personal bank account into this mobile wallet account. On ICICI Bank's books, the money goes into a pooled account. And so the money, all of the money from all of the users of this mobile wallet is sitting in this pooled account, which is very inexpensive for ICICI once all of the money is just sitting in there. And then Stellar comes along and creates a distributed ledger for that pooled account and just keeps track of where, like which customer is owning which funds. And so from the Stellar perspective, it's just a matter of accounting rather than actually moving money around. And since the cost is so nominal, ICICI has made the service free to customers. So the value add for the customers is that it enables the expansion of the products they have access to. And it even lets the customer transfer money easily to other people who have mobile wallets on the Stellar network. And that's a cost that is absorbed by Stellar or passed along to the customer by Stellar. So I think this is a really interesting way that, that partnerships help to create new offerings for existing customers. The third thing was data collection, use, and management. Now, I don't have to remind this crowd of the huge volumes of data that are available to help financial institutions make decisions. This volume of data has grown exponentially over the past 10 years, and it is expected to continue to grow. There are two partnerships I'd like to highlight here. One, Deepening Data, and the second is EFL Global. They do slightly different things. Deepening Data is partnering with a major bank in the Philippines that we highlighted in the report. And what Deepening Data does is they say to the bank, let us be the ones to curate the data so that you can actually make use of it, because there's so much data out there and it can often be really messy with duplicates and false information and lots of blanks. And so Deepening Data has a big data machine that they basically put all this data through, and then it comes out clean on the other end, and then they can deliver it to the financial institution in a way that the financial institution can use it to make decisions about customers. What I really like about this is, I think this model, intentionally or not, recognizes that there are some things that mainstream financial institutions like to keep as core to their product offerings. EFL is doing something really interesting as well. EFL Global partners with Microbank and also with Santander. And in both cases, with Microbank and with Santander, EFL provides a psychometric credit score for the institution to help the institution to make decisions about thin file customers. So they're actually creating data using information that the customer tells EFL Global about themselves. Now, one thing that's fascinating to me about this partnership between EFL Global and Microbank is that EFL Global is operating with Microbank in Spain with low-income customers, and it has to share its algorithm or share pieces of its algorithm or talk about the inputs to its algorithm with Europe, with the government, or at least that's coming down the pike. And so in this partnership between EFL Global and Microbank, EFL Global is learning to operate its psychometric scoring in an environment where the regulatory issues are a little bit concerning. And so that's a great example of the fintech learning a great deal and the bank also learning a great deal. The fourth way that we saw partnerships helping to enable financial inclusion was through deepening customer engagement and product usage. And for this, I'll highlight a fintech that we talked to called Juntos Finanzas, or just Juntos. Juntos works with two institutions that were in our sample. One was BBVA Bancomer, which I mentioned before, and the other was Bancolombia. Now, Juntos provides automated SMS conversations enabled by artificial intelligence. They send tailored text messages to customers, reminding and nudging them to save and become active users of bank services or whatever the partner decides is important for Juntos to promote. Customers can respond on the platform with more information about their financial needs and their financial goals, and then this information is used to inform future communications. So it's like a very smart AI applied to increasing the financial health and financial capability of the customers, with the ultimate effect that it will deepen customer engagement. Now you can see how complicated this is, because Juntos is actually the one that's managing this SMS conversation with the customers, but for regulatory reasons, BBVA has to hold the customer data. So BBVA gives select data to Juntos that they can then use for these interactions they have with customers, and then Juntos sends back to BBVA all of the data that they collect, and Juntos doesn't own any of that data. What's really fascinating about this model is that Juntos is so good at this conversation that they even get Merry Christmas messages from customers. It's just so effective at creating this personal relationship. So I was thinking about my own financial services, and like, when was the last time that I even thought to tell my bank, or even my banker, like a person, when was the last time I thought to tell them Merry Christmas? Or when was the last time they were in my contacts or first on my my home screen on my phone? And that's like a magic thing that Juntos has been able to do for customers. I'd like to go back to the slide where I talked about the 4 different barriers to financial inclusion that partnerships address, and read this quote. This is from Zia Zaman, who is he is in charge of MetLife Lumen Lab, and then he's also the Chief Innovation Officer for MetLife Asia. And he said, "You can never innovate faster than the market. By partnering with Fintechs on known challenges and by committing champions to the startups, we can get more innovations into the hands of our customers sooner." Zia told us about this partnership that MetLife India has with a virtual reality startup called Imaginate. MetLife India had this problem of having limited branches in India. So even in major cities like Mumbai and Delhi, they only had 1 branch. And if you've ever been to Mumbai or Delhi or Bangalore, you know that it's a huge city. And if you're a customer trying to get to a branch that's across town, it might take you half or 3/4 of the day. And then when you get to the branch, since there's only 1 of them, there are always long lines at these MetLife branches in India. And so as India thinks about its expansion as MetLife thinks about its expansion in the India market, it had this challenge and couldn't think of solutions for this challenge that would be effective at what they were trying to accomplish. But then they found this virtual reality company called Imaginate. And I thought this was crazy, but I became convinced after a conversation with Zia and his colleagues, and then also with the CEO of Imaginate. The technology is a virtual reality headset that can just be a smartphone with a cardboard piece around it. And while there's a significant proportion of the Indian population that does not have a smartphone right now, as we look forward to the future, we expect that more and more customers will adopt smartphones as battery life improves, prices kind of come down, and connectivity increases. And so MetLife India is preparing for this future by integrating this technology into their branches first, and saying to people, would you like to not wait in line today, because you can step off to the side and try this virtual reality customer service interaction where we can try to address your question that way. Their ultimate goal is that they can get this virtual reality technology out of the branches themselves and then into the hands of customers either in their home or at some satellite location. And so I think that is the best way to put an example to Zia's comment that you can never innovate faster than the market. So moving on, we found financial institutions organizing for innovation, or at least starting to organize for innovation. Like I said, there are a lot of failed partnerships. Fintechs are a little bit discouraged about what the landscape looks like, and it takes them a long time to be able to form these partnerships. But one thing we are hopeful about is that things are getting better in terms of forming partnerships, and financial institutions are finding ways to create space for innovation in their institutions. And I'll talk a little bit about what this looks like. There are different ways that we saw financial institutions sourcing partnerships. And I thought maybe those that were well organized for innovation would have some streamlined process of finding fintechs that would work for them, but that wasn't the case. That banking executive that we talked with at ICICI, who had just finished reading a book about blockchain in his spare time, as many of us do, of course. And this book mentioned the fintech Stellar. He was intrigued. He thought about this idea for blockchain. In India, it's a little bit complicated because blockchain is, or cryptocurrency is actually illegal. And so he had this challenge he was up against, that the cryptocurrency is illegal, but he still wanted to use blockchain in some way for some product. So he actually just called up Stellar, which he had read about in a book, and said, what can we do together? And so this was a very ad hoc way of sourcing a partnership. Together, they were able to create this mobile wallet that I talked about that relies on blockchain technology and a distributed ledger, but doesn't actually use cryptocurrency legally because all of the funds, like I said, are sitting in that pooled account at ICICI. Mainstream financial institution, Société Générale in West Africa, and they talked about going through a more traditional RFP process, considering multiple fintechs, and they ended up choosing TagPay when they wanted to create a mobile wallet. And so they looked at a handful of fintechs. They had a list of things they wanted. They had people submit proposals, and they went through a very organized process. Both of these seem to be valid ways of sourcing partnerships, and both ended up in very successful partnerships. What we found about what was in common between these different ways of sourcing partnerships is that there was an internal champion in the financial institution that had a budget and also had the mandate to be able to source partnerships. In fact, the head of innovation at İşbank in Turkey thinks of himself as a matchmaker and all that entails. All of the institutions we talked with wanted to make easier the process of moving from idea to partnership. The context of this conversation is that partnerships, the process of partnering is uneven. There are just a few people on the fintech side, an enormous number of people on the financial institution side. If you say to the whole group of people, those few on the fintech side and that long line of people on the financial institution side, the partnership is going to take 3 months from start to finish. The fintech is like, oh, 3 months is such a long time. And the financial institution is like, oh, 3 months is such a short time. And so there's this huge mismatch. But we're seeing mainstream financial institutions put together streamlined processes where if the partnership is under a certain risk threshold, it doesn't have to get as many approvals. We're seeing sandboxes that insulate a partnership process from even compliance or the board if it doesn't meet a particular criteria. And then internal champions. For example, ING requires that every fintech partnership have a sponsor at the top 2 levels of the institution to make sure it stays on people's to-do list. But forming even the most successful partnerships is extraordinarily difficult. So that partnership I mentioned with Santander and EFL Global actually took 22 months from start to finish. The partnership I mentioned with MetLife and Imaginate took 9 months. There's a difference here in terms of the product that's being offered. So Santander was offering loans, and they required a longer pilot period that was about a year, whereas Imaginate is more customer service, so that's 9 months from start to finish. But still, we found that forming even the most successful partnerships is extraordinarily difficult. The good news is that it seems to be getting easier, and we're optimistic that we'll see more partnerships between mainstream financial institutions and fintechs. We heard from fintechs that they're finding it easier to just have like canned responses to questions they get. So for example, Demis Data often gets a question about where they store their data. before it goes back to the financial institution, because data storage is a big issue for national governments. And now they just have like a standard response that they give that it doesn't take them long to put together. And on the financial institution side, we hear reports even from Fintechs that things are getting more quick from start to finish. Mainstream financial institutions now have a good sense of who to go to for what, and can get to those people more quickly. We found that financial institutions find creative ways of ensuring partnership stability, and I'll just give one example of this. When we talked with Carlos Lopez Moctezuma of BBVA, he said that, we asked him about the negotiation of the terms with the Fintechs that he worked with, and he said, I'm actually very aware that when it comes to working with us, a big financial institution, we might be the Fintech's cornerstone client, and we might be the ones that are funding their runways for a long time. And so instead of just trying to get the best deal for ourselves, the bank, we try to give a fair deal for the Fintech, because we really need them to be around for the sake of stability. And I thought that was pretty cool. I don't know how widespread that is, but I think that that's an indication that mainstream financial institutions are very aware of some of the challenges that these Fintechs face. In terms of the future of partnerships, they can go many directions. I'm going to keep this slide up so that you can look at it. But one thing I do want to say is, I think that partnerships between Fintechs and mainstream financial institutions help to secure the financial future of banks, payment companies, and insurance companies. The segment that they're going after, these emerging consumers, are also trying to, they're under claim from alternative providers like Facebook and WeChat and Alipay and Apple and Google. And we see a lot of third-party providers that are offering maybe just one financial service, but want to offer it on the back of their brand platform. And that's a big threat to mainstream finance, in my opinion. But I think Fintechs can help mainstream finance get back into that relationship with the customer, that really close relationship. We heard a quote from Benoit Legrand, the Chief Innovation Officer at ING. He said, "Historically, financial institutions maintained that customers would come if they built good products. But now financial institutions need to reinvent themselves to be platforms where customers are empowered again. Financial institutions have to learn to move and rotate around customers." What's at stake here is not the longevity of the financial institutions, because they're going to be around for a really long time. I think for forever, for as long as we have a financial system. And we're going to see those big players. But the question is, what is the role that they're going to play in the future? Are they going to play the customer-facing role and be able to offer very tailored services to customers and address customers' needs? Or are they going to play a back-end role powering the engagement that customers have with third-party providers? I hope, for the sake of financial institutions, that it's the former. I have to throw up the slide to thank all of these folks who participated in the research. I can't list them all, but now let me turn it back to Leon so that we can have a discussion about some of this.
Okay, thank you, Sonia. That was terribly illuminating. I think you've exemplified just how powerful the partnerships are. It's certainly a solution for financial inclusion, because of we've seen innovation has driven the ecosystem. We're going to open it up to questions now. And before we do that, we're going to put up a poll, and just wait for the poll to come up. But in the meantime, can I ask you to send through questions while we load the poll? Okay. I will close in a few seconds. Great. Thanks very much. Okay, just waiting for some questions to come through. Okay, I have one question that's come through so far. Thank you, Sonya. What opportunities are there for fintechs who aren't able to partner with financial inclusions for some reason? Are there accelerators and incubators that look at financial inclusion specifically that can help these fintechs become big fintechs? And that's from Sunil in Mumbai.
Thanks, Sunil. Yeah, there are a lot of labs and accelerators and competitions and lots of different opportunities that fintechs can take advantage of if they're interested in financial inclusion. We heard different things from them, but they all seem to have at least some focus on financial inclusion. And so when we talk to, for example, to MasterCard Labs in East Africa, they said that probably about 10% of their portfolio of fintechs are focused on financial inclusion. So that's promising to me. I do think that this is a really exciting niche for fintechs to pursue financial inclusion because, you know, thinking back to those 4 challenges, Leon, do you mind going back to that slide? Thinking back to those 4 challenges that partnerships between financial institutions and fintechs address, some of those challenges aren't things that mainstream financial institutions would be willing to give up when it comes to middle-income consumers. So, for example, sourcing new customers. Financial institutions are actually willing to let a fintech maintain the relationship with emerging consumers that they wouldn't get access to otherwise through these kinds of partnerships. So I do think it's a huge opportunity. So yes, there are labs and competitions and accelerators, and we saw partnerships being sourced through those things. MasterCard Labs said that many mainstream financial institutions look through their portfolio of fintechs because these fintechs have almost been vetted by MasterCard Labs, and the financial institutions are like, well, if MasterCard Labs is working with them, then they're probably a good institution for us to work with because they probably have a proven and scalable model. Having said that, I do know some investors that have candidly told me we try to tell our fintechs not to pursue partnerships with the big whale or the big financial institution at the very beginning because it's very risky. I said at the beginning that one of the people we talked with said that he estimated about 80% of partnerships fail, and we think that number's coming down based on our research. And those that succeed succeed fabulously. They're so amazing. But when a fintech is just starting out, it might be better for them to work with smaller institutions that have a higher likelihood of success.
Thanks, Sonya. Question from Mameto in Manila. Besides the technologies being partnered with big financial institutions, what are the hottest startup technologies fintechs are offering?
Sorry, can you repeat that question, Leon?
Yeah. Besides the technologies being partnered currently with financial institutions, what are the hottest startup technologies you're seeing that fintechs are offering?
Oh, that's a really good question. I think I'm supposed to say blockchain based on who's on this call and based on Leon. I do think blockchain is still a little bit unproven in terms of its value add beyond what we already have out there. I think this virtual reality thing is actually quite interesting when we think about the relationship between financial services and customers. You know, everybody wants that close customer relationship. Every financial institution, every fintech, every third-party provider or social media platform wants a customer to, on a major holiday, go into their phone and tell the company Merry Christmas, because that's a sign that there's such a close relationship. And so, that magic, that secret sauce that Juntos has, that fintech Juntos I talked about has in terms of the customer relationship, I think that's key. So technology that gets financial institutions and fintechs to that customer relationship is the technology that I'm watching very closely. So I do think virtual reality is quite interesting. I don't know what it's going to become, or whether it's going to become mainstream or not, but I think that's fascinating in terms of our actual relationship with financial services. I think to the extent that other technologies get us to that close customer relationship is really critical. And that customer relationship is key, not just because of the technology that enables it, but also because having a brand and a customer relationship makes the company that has established that relationship much more valuable. So some of the back-end technology that we see could be significantly disrupted, and customers would never know. Like, when was the last time you called your clearing and settlement company that your funds go through? Those things can be disrupted, and that market can change, even though it's a really big market. But I think the customer relationship is something that's really special and enduring.
Yeah, thanks, Sonia. You'll know from the conference we held, which you spoke at. We had a whole lot of startups that looked also at financial inclusion, and it seems RegTech technology is a hot. One of the hottest technologies too. We're seeing a lot of startups in that realm. So there's a question from Ahmed in Cairo. Sort of a regulatory ventured. Sometimes the big players don't want to interoperate for anti-competition reasons. How easy or not is it for fintechs to connect to the big players like mobile operators?
Oh, that's a very good question, and of course it depends on the market. Yeah, so we saw different configurations of partnerships that naturally emerged from the regulatory environment. For example, in Turkey, it's very clear that the mainstream financial institutions have to own the customer relationship, and everybody has to go through them. So fintechs wanted to work with mainstream financial institutions because there was no other way that they could own the customer relationship, and we see that in some markets. In other markets where mobile network operators own the customer relationship as well, as in many places in sub-Saharan Africa, and now increasingly in other parts of the world, in India, and in parts of Southeast Asia. We see fintechs more desiring to partner with the mobile network operators. One example in our sample was MicroInsure, which is partnering with mobile network operators across sub-Saharan Africa to deliver insurance products. I think I wouldn't have characterized MicroInsure as a fintech when they first started about a decade ago when I was at Opportunity International and they were our subsidiary. But now that they're operating primarily through digital channels and delivering subsidies nearly instantly in comparison to other things in the insurance world, delivering the payments on the premiums or the claims payments nearly instantly, I would put that in that category of having developed a really nice relationship with mobile network operators. And mainstream financial institutions are starting to pay attention. So for example, you may have seen that AXA, the huge global insurance company, invested 46% in MicroInsure, a 46% ownership stake, and see this as their future, in part partnering with mobile network operators, but mostly just saying, like, who is the most in touch with the customer, and if that is the mobile network operator, that's who we're gonna partner with. I think a lot has to happen from an infrastructure and regulatory perspective to enable that. Leon, I'd be interested in your perspective on this because I know this is much more your area than mine.
I think we're going to have to do it offline because we're running out of time and we've got about 6 questions still to go through, but I think we've got time for one more question. From Melissa, how do you define a successful partnership for the purpose of selection? I think we could just answer that quickly because we've got about a minute left in the webinar.
Yeah, we define it very simply as a partnership that exists and that is continuing to operate, because so few actually get to the point where they are in operation and out of the idea or the pilot stage. So that's how we defined it for the sake of our sample. Having said that, I think that's a valid definition also because the mainstream financial institution would just drop the partnership if it wasn't sustainable or if it weren't sustainable. And so, you know, when you see a partnership between a fintech and a mainstream financial institution, it's probably one that is making money for the financial institution and that is sustainable for the fintech as well.
Thanks very much, Sonja. Unfortunately, we've run out of time, but just to folks like Nihi and Mohit, Rene, and many others who've sent in questions, I'm sorry we aren't able to get to your questions, but if you could possibly send it to us or we pass it on to Sonya, I'm sure she can answer offline. So again, thank you, Sonya, for your incredible research and to your co-authors. It's a much needed study, and you certainly filled a great knowledge gap. And to that point, we're going to run the quiz now. You should have the quiz link in your email box. Use your login for accessing the quiz. Again, check your spam folder if you can't see the link for some reason, or email info@dfsobservatory.com if you can't log in or can't find the link. Again, you have 2 hours to complete 10 multiple choice questions, and after the 2 hours, they won't count for certificate purposes. So I would ask you to look at dfsobservatory.com to go through the website and register for the next set of webinars. And thank you very much, everybody, for participating. Apologies again for the unexpected technical delays, but we got